And hi again. In this session we're going to take a look at macroeconomic trends, and in particular we're going to review some of the major approaches to economic forecasting, demonstrate the use of economic information, the sources of information, and so on, and also identify some of the major approaches to forecasting things like exchange rates and the implications for things like interest rates, and specifically look at the effect on different classes of assets, leading into the next session in Chapter 5 of McGinn's textbook, where we start to talk at asset allocation. So for today, we're going to start off with the growth in the economy. If we're part of a growing economy, it's relatively easy to find growing companies. Companies tend to rise with the economies in which they're based. So faster growth for the countries in which we have our markets, the better our companies will do, the better our investments will do. So what is the long-term trend in GDP growth? GDP, GNP, we tend to focus on GDP, considering the location of the country and the effect of the imports and the exports on the company's business. Business cycles tend to fluctuate around this trend. In other words, the cycles tend to evolve with a slight upward drift according to the rate of growth. For developed economies, perhaps we're looking at a real rate of growth in the long term of only 2 or 3%, but for emerging markets, perhaps much higher, 5%, 7%, even for a sustained period of time. Understanding the trends are easier to predict than the cycles. The trends are more meaningful in the long term. If we're making an investment that's going to last for 30 years, then the trend is going to be our friend. Sudden changes, of course, are described as shocks. They're not part of the trend. They're something that is going to actually work against the trend. And so we'll also discuss briefly some of those shocks and take a look at how economic growth is going to be a key factor in the forecasting of the present value of our investments. Now, the country's growth is something that it tends to be influenced by a number of factors. I really liked the title page or cover page that they had on The Economist a few years ago, where they were talking about Canada being the fastest growing of the G8 countries, and it had a picture of a moose with sunglasses on, and basically said Canada was the place to be. More recently, we've been talking about Canada as having not quite so successful an economy. Now, of course, there are things that drive that economy. There'll be factors like the levels of debt that the country has to face. There'll be the primary economy, wheat, and in Canada's case, especially oil. Other factors like technology, perhaps. So what's going to happen to the country? How well will it do compared to other countries? And that's something that we look for as part of the long-term trend. Some of the components that help to influence growth are our ability to grow by using our basic resources, mostly labor inputs. So how big is the labor force? What are the demographics that we're working with? Have we got an aging population? Have we got a bulge in the population of younger workers about to enter? How about things like labor participation and immigration? Those are also going to be important factors. Aside from the actual change in our employment of our resources, we also have got the actual improvement in labor productivity. Essentially, and typically, substitution of capital for labor. Things like automation may make us more efficient, but usually that's a small part of the total growth picture in a developed market. So growth by improving our ability to channel capital into our business processes. Governments may also influence growth, and so government policy, both fiscal and monetary policy. And of course, that has to be a long-term plan. That means that excessive deficit spending and increased long-term debt for the country can't be a good thing. But an appropriate level of growth, appropriate spending on infrastructure is going to be an important part of our assessment of the growth potential for the economy. Crowding out of private sector investment is also a major concern. So if governments are going to be essentially competing for capital with companies, then that's not a good thing either. Encouraging an effective competitive system will be part of our process as well. Providing infrastructure, and by the infrastructure we don't just mean things like bridges and roads. We also talk about things like providing the fiscal infrastructure, a good banking system, a legal system that works and doesn't hold back the business environment. Human capital development, and of course that's education. How are we producing? Are we investing enough in education? Are we producing the right kind of graduates? And of course, having a tax system that's going to be competitive internationally and also one that's not going to hold back investment. Now, we mentioned shocks earlier. A shock, of course, is something that we'd certainly recognize the shock. 2007, the financial crisis, that was a shock to the system. It went contrary to a trend, and a trend of growth in the economy. It was caused by, a number of things, particularly weaknesses in our legal infrastructure, and the banking system fell apart, and even though we had capital to invest, the banks stopped lending. And so clearly that was a shock. Oil shocks have also been good examples of this. We've seen credit crunches in other economies. The timing of these aren't predictable, but the fact that they will occur is something that we generally expect to see. So they do occur regularly, but when, we can't predict. Typically, they have short-term impacts, so we may see a 3-month or a 6-month downturn, unusually a year or more, as in 2007 through to 2009, we definitely saw a longer-term impact. But they do tend, on average, to be have shorter effects on the market. Other factors that may be important: the network economies that we operate in. For example, Canada operates within a North American framework and within a world trade framework, a Pacific Rim trade framework, and so on. So how well does our trade system work? If in Canada, if we could only consume the things that we produce, our consumption opportunities would be very limited. So we do depend on having a broader system of trade. To evaluate how we're doing within that system of trade, we look at things like our balance of payments. Are we importing much more than we're exporting? Is that sustainable in the long term? It may be if we have the right kind of counterbalances in things like investment. So if we have more investment coming into the country than we have going out of the country, that may help us to offset one of those trade deficits that we're concerned about. We also look at things like the balancing effect of interest rates and exchange rate mechanisms. This is especially obvious if we work in an economy where the currency is pegged to another. For example, if you're working in Hong Kong and the Hong Kong dollar is pegged to the US dollar, then the amount of foreign exchange reserves essentially guarantee stability. But if those foreign exchange reserves go, then we know that peg is not going to be able to hold. So interest rates tend to be sustainable provided we have got the cushion that we need in things like foreign exchange reserves. Interest rate differentials are going to also be part of this. If we have a country with a very weak currency, then we would expect interest rates to be higher. Investors would rather use their local currency to buy foreign currency and invest their money into a solid currency where they know that the value is going to hold without high rates of inflation. We talk about developed economies and emerging economies, and remember that these guidelines shift. We used to describe countries like Japan as being a developing economy. Well, clearly Japan is a developed economy, and many of the other countries that we used to describe as being emerging economies have probably crossed that line into fully developed economies. That's good news and bad news for those emerging economies, because emerging economies are characterized by having a higher rate of growth. How they become developed countries is through a number of mechanisms, including reaching full employment, having a high level of participation in the workforce for people of all ages, having high levels of training, making sure that marginal contributors to the economy are contributing at a very high level. Immigration, in our case, might be part of that. Savings might also be part of that. Savings are maybe a good thing, although quite often savings means that we're not going to be putting the money into consumption. So there is that, what we call a paradox of thrift. If everybody becomes a saver, the economy could become in trouble because the money that we're saving is money we're not using to hire other people. So appropriate levels of domestic savings. Emerging markets may also be characterized by weak political and fiscal infrastructure. Lack of legal system that works, that's trusted, contract law that doesn't allow us to trust our contracts. Perhaps we're missing things like intellectual property law, protection for our intellectual property. The legal system itself might break down, the political system might break down, and we perhaps don't have a system of banks that provides us with adequate credit in order to be able to build companies. And if these are the cases, then we may require significant reform in the structures, in all of those things, in order to be able to progress. Historically, emerging economies tended to be driven by certain commodities. Perhaps it would be oil or copper or tin, rubber, timber, and eventually those commodities that drove the economies would cease to become the major focus of the economy and eventually balance out. Think about Malaysia, for example, which has become a financial services center, a manufacturing center, high-tech in some respects. Essentially, their economy was founded on things like palm oil, rubber, tin, and essentially they migrated over time from being a commodity-driven economy to being a 21st century technology economy. When we're trying to understand how countries work and how economies work, we have a number of sources that we're going to talk about in a couple of minutes that will help us to understand this. But some of the questions that these sources help us to answer: how sound are the financial policies of the country, the fiscal policies that are set by the government, the monetary policies of the central bank? What are the growth prospects? Current level and the trend in growth, but what's the future growth going to look like? Is the currency one in which we feel comfortable investing? Is it competitive? Are the country's accounts, its balance of trade, its portfolio and direct investment accounts, its foreign exchange reserves under control? Is its external debt under control? Is there sufficient capital available inside the country? And is capital turning over? Is it reinvested in the economy? Or when capital is freed up, is it escaping? Have we got capital flight? Is our political system and our political infrastructure going to be sufficient in order to be able to grow our country? There are a number of sources that I would recommend. Unfortunately, some of them, most of them, require a password or a subscription. A good example of that, Euromoney and Institutional Investor were two good ones that eventually merged, and now they have something called EuromoneyCountryRisk.com, where we can actually get information about different factors that help us to spot the level of risk and the desirability of investment in those markets. So things like the economic, political, the structural, the access to capital, national credit ratings or sovereign credit ratings, and levels of debt. Things like that could be part of an overall score. And then we can compare ourselves to other markets. You can see on this particular chart, with green being good, Canada is definitely doing pretty well. The United States appears to be a benchmark, along with countries like Britain, Spain, Germany, followed by countries like Canada, Australia, and so on. And of course, using the standard methodology, countries that are orange and red are probably going to be more problematic. Well, we would want more information, and if that was the case, then we would have to find out much more about the country, about their system of governance, about their accounts, and so on. So this becomes part of our overall scan as we're trying to understand the macroeconomic factors that are going to determine whether or not we should invest or not. Some of the tools we use, some of these you're already familiar with, things like econometric modeling, predictive models that will essentially use some of the main factors that we understand drive economic growth. And then we'll look at the expectations of those particular factors. So factors like debt and average income, levels of education, corporate and national governance are those factors. Then we can build those into a predictive model that'll help us to understand whether this is going to be a good place to invest. And of course, an econometric model provides us with an overall score, that helps us to rate different countries. We build an econometric model by looking at historical data and apply that to predictions or expectations about the future. Certain economic indicators will be part of this. We'll talk a little bit more about those in a minute. Leading and lagging indicators, coincident or type of indicators, and different indices will be part of that. We'll also take a look at a simpler checklist approach. As we said before, econometric modeling, key advantages, well, it has a certain dependability within the model. We can misspecify a model, but the model itself helps us to predict an event within a certain degree of uncertainty. There's always going to be a bit of error in our models. And so we will build a model, we'll look at the model and decide whether or not we can live with the degree of error. We can refine the model over time as we get new data, continue to backtest it against those changing conditions, and this should help us in the long term to understand whether or not these economies are going to be a good place to invest. Difficulty, well, they're complex to construct. Not everybody who uses them will understand how they work. The data inputs are also subject to individual measurement error. We may not be correct in our measurement of certain of the factors. The output itself is subject to a certain amount of noise or uncertainty, and it tends to miss certain events. In other words, it may spot a trend, but it may not spot cyclical events, especially recessions. There are a number of indicator. Remember we said there were leading, lagging, coincident indicators? Well, leading indicators have to be the most valuable. If, for example, someone tells you that copper is a good indicator, copper prices are a good indicator of business cycles, that would be useful because if you saw that copper prices were starting to rise, it would tell you the economy looks like it's doing well. And in a rising economy, if copper prices fall, that would suggest that things are going to turn bad. So that would be a good example of a leading indicator. Lagging indicators tell you something that you partly already know. They confirm what you know. And coincident indicators, of course, happen in real time. And essentially are telling you what you apparently seem to be witnessing, and again provide confirmation. So leading indicators we especially like. They're intuitive, they're simple to observe and construct. We may see this information or be provided this information by specialist analysts who focus on that one type of information. We can build them into our own predictive models, have them tailored for our own modeling use. And these tend to be well supported by research that's been demonstrated in the literature. Disadvantage, inconsistent performance historically, and false positives, false messages that things are going to change. Now, a checklist approach is one that's the simplest. So, advantage, it's easy to understand, it's easy to communicate. It easily incorporates changes, but our checklist is based on essentially our rules of thumb. If certain things appear to be happening, then stay home. Big clouds outside, okay, that's a big X. We're not going to go out. It might rain. Of course, approach it like that, a checklist, simple checklist approach like that is subject to a huge amount of error. Now, when we're looking at individual asset classes, and we're going to look at several in the next few slides, these are going to be subject to each of these asset classes are going to be subject to different pressures, different effects from things like currencies and inflation and growth. When we talk about cash, we almost never talk about cash. We talk about the equivalence part, money market instruments, short-term financial instruments. And if you're a manager putting together a portfolio of these short-term instruments, we can earn higher returns by going for longer maturities. Instead of keeping it in overnight deposits, perhaps we stretch or extend to 30 days or 60 days to get higher rates of return. Or perhaps we take on more credit risk by investing in, instead of just government bonds, perhaps good corporate notes. The yield curve tells us a little bit about what to expect for cash and equivalents. We discussed that in our previous session. And the manager has to think about the things that are going to affect the short-term future in order to be able to decide whether or not to go long or to shorten up the investment period, the duration of the investments. And of course, surprises are things that we can't predict. How much surprise can you afford to live with? We have bonds as well. Now, the best bonds, the best quality bonds are called default-free bonds. Typically, we're talking about government bonds and government-sponsored institutions like the Canada Mortgage and Housing Corporation, for example. For developed countries, where we have a fiat currency, a currency that we can essentially trust, there's very little chance of the government not paying their bills. Of course, what they pay you with, the currency they pay you with, could lose value because of inflation. And that means the only residual risk, the only risk you have to live with, is the risk of inflation. So that means that the return that you get gets broken down into the real return and inflation. And again, that comes back to how stable, how safe is the currency. To invest in these kind of instruments, we really just have to focus on inflation. Everything else is pretty much under control. Corporate debt builds in a chance of default. So AAA, AA, single A, B-rated bonds, and junk bonds have got a chance of default. So we not only have to be aware of the things that affect the particularly safe debt, the government bonds, we also have to be aware of the probability of default. Now, that is essentially a simple thing to do. If we believe the rating agencies, we'd say that we expect a greater credit spread for riskier bonds. Perhaps if the risk-free rate is 2%, we require 3% for a AAA rated bond. That's a 1% or 100 basis point credit spread for a AAA bond. For a BBB bond, which is still good investment grade, maybe we require an extra 2%. So a total of 5%. That's 2% for the risk-free rate plus 3% or 300 basis points credit spread for a BBB, and so on. Well, that generally works out as a safe thing to do for the short term, but bonds are long-term instruments. And the credit spreads change as we become more comfortable or more nervous about economic prospects. As we get into a rough economy, the credit spread will generally increase, and people will want to take their money out of low-grade bonds and put them into higher-grade bonds, just to be safe. And of course, if everybody wants to buy the high-grade bonds, it bids the credit spread down for the high grade, and the low grade, the credit spread becomes greater. But we can see an example of this. And this is something that comes from Moody's Quarterly. And you can see as we move through time, the difference between, and these are all speculative grade bonds, the green line represents BB rated bonds. And so the credit spread would be something like 400 basis points or 4% for BB. But 2008, 2009, when we had the financial crisis, people were dumping their BB rated junk bonds, and then they were using the cash to buy A-rated and BBB rated bonds. And so that was putting pressure, driving down the price of these bonds and driving up the required yield. And that's why we see by 2009 the credit spread went from about 400 basis points to about 1,100 basis points in 2009. And it was even worse for the single B, and far worse for the triple C. In fact, those triple Cs had a credit spread of 2,000 basis points or 20%. That means if the risk-free rate was 2%, then the rate for those triple C-rated bonds was 22%. That's the yield to maturity on those bonds. Now, if you're holding onto those bonds in 2007, as the yield goes up, required yield goes up, the price of the bonds goes down. And your investment in bonds, definitely not good. So we really have to be able to see what's going to happen. Now, nobody could have seen the financial crisis in 2008. but as much as we can, we predict for the worst case scenario. And as a C-rated bondholder, we know that this is definitely the worst possible case. Other bonds that have risk include the emerging market bonds. These are typically sovereign, but they could also include things like telecommunication or telephone company, public utility bonds, who raise a lot of funds internationally. Many are guaranteed by the governments. However, the problem with government bonds in emerging markets, the value of the currency might be very weak compared to the hard currency or fiat currency countries like the United States or Europe or Canada or Japan. So when we describe government bonds, we call it sovereign debt, and some of the near sovereign debt includes the utility companies because they're typically guaranteed by their governments. They may have to borrow in foreign currencies because nobody wants to take on a bond that is denominated in Venezuelan bolivar or Kyrgyz som or a variety of other currencies. And unfortunately, this means that the foreign exchange risk is getting passed on to the issuing governments, which they may not be able to pay either. And so that might create other problems. This means that they can't use inflation because they're not issuing their own currencies that are used to provide these bonds. Otherwise, the default risk is similar to that for domestic sovereign debt or corporate debt if it's lower grade. So this means in order to forecast sovereign risk, we have to understand the politics of the country and all those other factors. Less common as well, we have inflation index bonds, and these would be bonds that provide a real rate of return. Every textbook talks about them, but they're not quite as common, although there is some municipal debt in the United States that is inflation indexed. Now, moving from bonds to stock, common equities have a variable effect depending on what's happening in the economy. The economy, it affects the earnings, but it also affects the risk. And if you think about the value of a stock being based on the present value of the cash flows discounted at the weighted average cost of capital, there are two opposite directions where things like inflation might take the company. The trend in growth tends to depend on things like the market, labor force growth, levels of productivity, competitive frameworks, government, subsidies, all kinds of things that could be a part of the overall value of the business. Company's profit tends to slightly lag the business cycle. So usually as the company is moving through that business cycle, profitability increases. It peaks just after the economy starts to move into a recession. And so the top part of the equation, the cash flows, tends to ride that business cycle. Information about the risk, on the other hand, it tends to reflect things like inflation. And remember when we talked about inflation, it tends to operate very differently to the business cycle. So there'll be an effect on the numerator and the denominator. That's why we talk about some kind of investments like those interest rate sensitive debts, which do very well when interest rates are low, performing better in a different part of the business cycle. Real estate has also got a complicated relationship with the environment. The returns are affected by the demand for the underlying asset. So if they're big families that are buying houses, then that's definitely good for residential real estate. If we need more commercial office space, that is also going to affect the real estate market. So if the economy is doing well and we're opening more offices, that puts upward pressure on real estate. They can also affect the cost of building. And so, for example, if we're having a boom in real estate, that means the cost of things like cement, steel will also be rising, which will be putting increased cost pressure on real estate at the same time. Lower interest rates, which are often observed in the bottom of a business cycle, essentially make it easier for investors to buy and may actually increase the value of real estate. And of course, inflation tends to push up the value of real estate. So there's a mixed effect. If the inflationary effect on real estate is greater than the opportunity cost of the lower or the higher risk, then the value of real estate tends to go up. Currencies, of course, have a complicated relationship, and we evaluate currencies, our investment in foreign currencies, using several different tools, and we'll talk about those in just a minute. Essentially, the exchange rate is about supply and demand. If everybody wants to invest in Canada, well, to do that, they have to buy Canadian dollars with foreign currency. And if everybody's buying Canadian dollars and selling, say, US dollars, the Canadian dollar goes up and the US dollar, in relative terms, goes down. So it's always about supply and demand for matched pairs of different currencies. In order to be able to predict what happens to currencies, we look at things like the trade balance. Are we importing more than we're exporting? If we're buying a lot of imports, that's obviously going to push down the value of our currency. If we're exporting, people have to buy our currency to buy our exports. That pushes up the domestic currencies. Part of this is going to be offset by whether or not investors want to buy into your country. If foreign companies are buying Canadian companies, they can only buy those companies by using Canadian dollars. So they have to buy Canadian dollars. That pushes the Canadian dollar up as well. Differences in interest rates may make movement of investment across borders very attractive. For example, if Canada has got 1% interest rates and interest rates are 4% in Japan, then we'd see a lot of Canadians investing their money in the Japanese market to get the higher rate of return. And of course, in the long term, that would have an effect on the currency, just as it has with portfolio investment, direct investment, and our trade deficits. Some of the ways that we measure this using certain tools. We'll look at I think about 4 of those tools in the next couple of minutes. One of the most common tools is called purchasing power parity, or the law of one price. It essentially says that a good that has a value in use on both sides of the border, accounting for the difference in the currency, should have the same price. It would make it very hard for me to go buy a truck in the United States because it's cheaper in Canadian dollars and drive it across the border. That, according to this rule, that if there was no difference in tax or registration, and no customs tariffs, no transaction costs, essentially those two goods would be worth the same value. That's the law of one price, or purchasing power parity. Over the long term, we'd say that this appears to hold. The very long term. We see temporary mismatches in parity that may last for 10 years or 15 years because of some of those differences. Taxation, difference in the product across borders, and so on. We see that capital flows may offset the purchasing power parity arrangements for very long periods of time. Another way of predicting what's going to happen to currencies is the relative economic strength, or the differences in the rate of growth. Countries with higher growth rates will see their currencies appreciate in value over time. Strong currencies are attracting more investment. That means that people have to buy into their currency to invest in that country, and that pushes up the value of that country's currency. So strong currencies attract more capital. Will the higher yield offset the likely depreciation in the currency? That becomes one of the questions that investors have to face. So things like this, combined with purchasing power parity, are going to be 2 of the most important factors: relative economic strength and our parity relationships. Capital flows partly offset trade flows. So if it makes more sense to invest in the Chinese market today, Canadians who wanted to invest in China would have to do that with renminbi. That means they would be buying renminbi, selling dollars, and that would push the Canadian dollar down relative to the renminbi and make it increasingly more difficult for us to invest in those markets. We may also see some savings investment imbalances, especially as a temporary indicator. Savings, as we saw earlier, bad for the economy, but good for individuals. So Excessive levels of savings may also indicate or suggest eventual capital flight from the country. We have covered a lot of ground in the last little while, in the last few minutes. So clearly, you'll have to read the chapter if you want to develop and understand all of the nuances. And it's a complicated and important chapter, Chapter 4. The lessons that we would like you to take away from the last two videos and this one in particular, the first step in understanding your investments is to understand markets. Is the market growing? What do business cycles look like? How effectively are the markets developing? Developing an understanding requires models, and models are going to be subject to error. We have errors in inputs, we have errors in modeling. And eventually we'll fix those models, and by the time we fix them, the world may have changed again, and our new models will also be flawed. We've also got biases. We have a natural inclination to misread models because of things like confirmation bias. Governments may also complicate our ability to choose the best market investments. Governments may distort investment, they may provide different rates of taxation, and they may also create barriers to moving capital from one market to another. And of course, once we've made all of these other investment decisions, we have to deal with the currency effects. A very profitable investment in a foreign currency may in the long term be a bad investment in our home currency, because what we've gained in higher yield, we've lost because of a devaluation of that currency. I hope I've given you something to think about, something to follow up a little bit further, and I look forward to talking to you about this in class. Thanks, bye for now.